There's one hell of a tangled web going on in the banking system. And while we got taco from Trump this morning, which is great, Donald Trump talked about how Xi Jinping is a good man and, China only respects strength, so we have to put up these unsustainable tariffs and make it look like we're being really, really aggressive. What actually happened over the last 24 hours and what we saw last night in the futures market with the NASDAQ down 1.3%, multiple stocks selling off 4%. I mean, it was a bloodbath in the futures market last night. Why? It was all because of the tangled web of the banking crisis, and how far this spreads is scary. And this story gets deep because what you're about to see is how an auditor could potentially fail at auditing companies, get fined millions of dollars, still be in the business of providing audits, only to give their own lender, the auditor's lender, only to give them potentially first looks at risky business that's going on so that those suits could then short First Brands with credit default swaps to make some big dollar hollers while they go bankrupt. It is a disaster, and it smells like fraud up and down every way you slice it. And a lot of the suits are going to be telling us on CNBC or around the world that don't worry, this is just idiosyncratic. Which when you hear somebody say a problem is idiosyncratic, immediately say, idiot. They're idiots. Because when you have smoke in one place, there's fire everywhere. This is the same kind of fraud that was rampant in 2007, and it's not isolated. It never is. It's just a matter of how bad is it going to get, and how much is it going to smell like 2007 and 8. Let me go show you a quick example, and then we'll get into the disaster of the story. Because history tends to maybe not repeat, but it certainly rhymes. Subprime mortgage market woes seem well contained. Here's a Reuters article from August 2007. And guess what this Reuters article tells you? It tells you the following. Watch this. The subprime mortgage market is little more than an asterisk in the overall economy, said a Roth Capital Partners economist. The concern that rising defaults among subprime borrowers will spill over into lower consumer spending is unwarranted, says a director of the University of Central Florida. It's the latest episode of hysteria. It's just a small segment of the overall market, and its problems aren't akin to a currency crisis or contagion. This is just everything's fine. These are just little idiosyncratic problems, and they'll burn out, we'll have some bankruptcies, and the economy will be fine. I hope so. And I so much want to believe in that hopium, but what we saw at First Brands, it goes deep. And I'm going to show you exactly how to watch for this potential contagion spreading. So, first, you got to understand that First Brands has apparently, we just saw this morning, their CEO has been down this road before. Literally, that's how the Financial Times article starts. You can't make this stuff up. The First Brands chief, Patrick James, has been here before, well over a decade before this bankruptcy that he's now gone through, showing over $11 billion in liabilities. The Ohio-based businessman was battling creditors in court over millions of dollars in defaulting debts and fending off allegations of fraud. So over a decade ago, this guy's getting rich, settling with people who were calling him a fraud, buying massive mansions in Ohio, and maybe not paying his creditors. And now all of a sudden, you're seeing the same thing happen again. See what I mean? With maybe it doesn't necessarily repeat, but it certainly starts rhyming. And this is where First Brands comes up. See, First Brands, they're not that big of a deal in the broad scheme of things. It's not really a First Brands issue. It's an auditing and it's an institutional money management issue. That's the problem that's potentially setting up for a real crisis here. So when we talk First Brands, understand it doesn't matter that this windshield wiper maker is going bankrupt, an auto parts supplier. They started as a windshield wiper maker. Who cares? Nobody really cares about them. What we care about is, what does this mean for the broader market? Why is it that all of a sudden we see the Fed repo facility, which fortunately today wasn't used, but the Fed repo facility is rocketing again. This, by the way, just to give a simple explanation of the repo facility, which is not to be confused with the reverse repo facility. I'll tell you, that gets really confusing, so I'll give you the bottom line here, okay? The repo facility, when this spikes up, which it hasn't since COVID up until recently, it means institutions need money. It means banks, credit unions, globally systemically important banks, or GSIBs, or other asset managers. They have treasury bonds. They can't liquidate them for their cash needs at night, or they don't want to, or whatever, because they don't want to recognize the losses on them. So they go to the Federal Reserve and say, yeah, hey, can I deposit this with you overnight? And can you just give me a bag of cash because I got some bills to pay? I'll pay you back tomorrow. That's how this works. In banking, even overnight matters. Like for us as humans, this doesn't make much sense because it's like, if you have a bill on your desk, you're like, I'll just pay it in 2 days. Like, who cares? It doesn't work that way for the banks, because they continuously have to be in compliance. Otherwise, they could lose their banking charters or just get fined by regulators, even for the non-banks, right? So this repo spike, fortunately, it's settled down today, but even Nick T at the Wall Street Journal is looking at it because he's like, whoa, this is a sign of a liquidity crisis. This isn't great. Now, are we seriously in major stress right now because of this First Brands or banking issue? No, not really. Right? This is where, if you look at high yield corporate bonds versus short-term treasuries right now, if you look at the ratio of this, usually you see this line basically spike up when there's big stress. Stress, or you could call it complacency. Stress is really low right now, where complacency is really high right now. Liberation Day had much higher credit spreads, the Japanese carry trade, the bank crisis of 23, the rate hikes of 22. Like, these were all moments of substantially higher spreads. So it really suggests, right now, markets don't really care that terribly much about what's going on with this banking poopy-doopy. It's one of the reasons why this morning, this is a little nuanced, but it's one of the reasons why this morning in the Alpha report, the stock market was down like 50 basis points on the Qs. And this morning, I'm like, look, in the very short term, this is bullish because Donald Trump is tacoing, which suggests we're probably not going to get bad news today. Donald Trump's tacoing on China. Oh, it's unsustainable, whatever, great. We're probably not going to hear of more bankruptcies today. We might in the next few weeks or months. But today we might end up getting a rebound, and I'd be looking at the Qs and specifically Tesla. Now, Tesla bounced on 414 this morning, and I always like watching for the first 5 minutes to see if we're going to revisit, otherwise bullish. And so there were a couple of course members who were nice this morning who left comments on this. Gold Josh says, finally caved and joined the membership in the Alpha Report. Already made my money back on Q's calls from this morning. Made about $1,500 on Tesla and Q's calls from the Alpha. Thank you, says Peel here. Peel, oh, that's funny. But anyway, these are the things we'll do. Like, even when the market's red in the morning, we're like, hey, strategically, we could get a bounce in the morning. That's playable. Just be careful. There's going to be profit taking in this market. So that doesn't mean the market's going to be green forever, but it creates an opportunity to trade, and that's the whole point. That's what we do every morning in the Alpha Report, and if you want to be part of it, not only you get my short-term ideas, you get my medium-term ideas, my long-term ideas, you also get the top 10 stocks to buy, you see what I'm selling, you see what I'm selling, you see what I'm buying, and you also get the courses, the all 8 courses when you join the Meet Kevin membership over at meetkevin.com. Use that coupon code SchumerSiesta. Now, with all of that said, let's understand what actually happened at First Brands. And again, this is a story that you really want to understand. This is not just First Brands. This has to do with $2 million fines from the PCAOB against the auditor for First Brands. And when you understand that the PCAOB, which is the Public Company Accounting Oversight Board, when the Oversight Board, which is authorized by Congress, fines the auditor $2 million for similar issues to what happened with First Brands, it says that the underlying fundamentals of a lot of our financial markets could be either fraudulent or rigged. And what we're seeing now are just the early dead fish kind of percolating up to the surface. And now the question is, how many more fish are dying below the surface? Understand this. The PCAOB sanctioned BDO. BDO was the auditor for First Brands. The PCAOB sanctioned BDO $2 million. This is a massive fine, okay? Like, That's huge. This isn't like, oh, you guys made a little oopsie doopsies here. Like, this is, you guys were criminal, is almost what the level of what this rises to. In fact, they went as far as not just sanctioning the company, they went as far as saying the actual individual auditors are also going to get fined. Look at this. Civil penalties for the company of $2 million, $35,000 and $25,000 for the actual individual auditors. That's crazy. So what happened? Well, what happened was this PCA, this non-PCA, the BDO is not a PCA, they are overseen by PCAOB, but they were not doing PCAOB audits for this company that they got sanctioned for, or First Brands. PCAOB level audits are the most rigid standards for auditing. They're deemed to be the best audits you could get in America, typically reserved for broker-dealers or public institutions. I pay tens of thousands of dollars extra at HouseHack every year now, including the last year, actually I think in the last 2 years now, to have PCAOB level audits because we want the highest standard of audits. And BDO didn't have that for First Brands or this company. And look at what happened when they got fined here for AAC Holdings. This had to do with short pays for insurance claims, like claims by AAC that they could make a lot of money in revenue from picking up short pays from insurance companies. But there was no proof that they actually had any historical evidence they could actually make that money. And so the PCAOB is like, we're fining you guys because you guys failed to properly evaluate this company that ended up going bankrupt, and you therefore failed to protect investors. And it all had to do with accounts receivable, which is really interesting because accounts receivable are exactly what the problem was with First Brands. So the First Brands situation, how does this work? So the First Brands situation is unique because you go from a windshield maker, windshield making company to basically a company that became a financing company for taking on debt-based IOUs. So really what it is quick example. Let's say you make these mugs. Okay, you're gonna sell me this mug for $10. Okay, so you give me this mug for $10, and I'm like, yeah, I'll pay you in 90 days. Cool. Well, what happens if I don't pay you? Well, you get burned, and that sucks. There's risk there, right? I'm giving you a note that I'm promising to repay you. Well, First Brands does this with a lot of different people, and now they're sitting around going, man, we can't really manufacture more of those coffee mugs because we don't have any money. We're waiting for all these bills to come in. So why don't we just call someone up? Hey, yo, bankers, can we finance and get some debt on these IOUs that we have, these accounts receivable? So basically on their balance sheet, the bankers come in and they go, oh, well, it says here your accounts receivable have a lot of money coming in. This looks pretty good. You guys got a lot of cash flow coming in. That's good. And did you guys get audits on these? And they're like, hell yeah, we got an audit by BDO, yo. And the bankers are like, oh, okay, you're audited? Oh, that sounds good. They're not paying attention to the fact that it's not a PCAOB audit. They're not paying attention to the fact that BDO got slammed for accounts receivable failures and fined $2 million for basically the same damn crap that happened at First Brand. They're not paying attention to that at all. Why? Because the bankers don't give a flying F. The bankers aren't looking at actually underwriting this product. I hate to say it. They're looking at how to make money. That's all. How am I going to make fees? I hate to say it, but that's how the soup business works, okay? That's why people don't like the soup very much. So, here's how the soup business works. Oh, accounts receivables look good. Okay, yeah, we got an audit. Oh, okay. We could package this. We could take this product and we could put, this is a high-yielding product. We could put all of this into this giant bucket, and then we could sell this to a bunch of little companies. And then we'll have fees for each one of these little tickets. We'll have a fee for every one we process. And, our investors will be left holding the bag, but we'll make a fee and we could disclose to them that these are audited, and we don't really need to look too hard because the auditors already did it. So, what do we care? And we're going to sell this product and make money. That's kind of how the financial system works. And you bundle this crap up, as whether you want to call them CDOs, collateralized debt obligations, which are somewhat similar to CLOs, a little different, collateralized loan obligations you see with commercial mortgage-backed securities, which that's a whole nother bubble. You end up finding that institutions can make a lot of money selling and packaging this crap. Jefferies. People look at Jefferies and they're like, oh, it's an investment bank. It must be regulated. Like, the government should be looking at Jefferies, right? Wrong. Nowhere near as much as a bank. Because Jefferies is called a non-depository institution. They're basically, an investment bank is a company that helps companies IPO or invest into certain packages of doo-doo to get a yield for their assets, right? So Jefferies doesn't have the level of regulation that banks do. And so they can much more easily just sort of rely on like a BDO audit or something miscellaneous for their investment products. And the banks, they don't really know because they're relying on Jefferies. So you remove a whole regulatory element here. And so Jefferies can get loans, and Jefferies can go create products that are full of crap, and they can bundle it together into something like Point Bonita, which is what they did. They bundled all these First Brands debts into a company called Point Bonita because they didn't even want their name on it. It's not like Jefferies Fund 17, it's Point Bonita. Oh, Point Bonita had the losing money. Interesting. So when all of a sudden the First Brands company starts not being able to pay their bills because they're not actually getting money coming in, or worse, they're total frauds and they're double and triple dipping on those accounts receivable. So in other words, you sell me this mug and then you have that accounts receivable and you're like, I could go to Bank of America and get a loan. I could go to Jefferies and get a loan. I could go get a loan from 3 different banks. Now you're double, triple dipping on the same accounts receivable. You're really just creating this tangled web of fraud. Now, who was able to profit from the tangled web of fraud? Enter Apollo. And this is where things get really interesting. And the way to see this is you kind of have to draw this out because it's sad. This is why the suits always win and retail usually always gets screwed. It's so sad. But watch this. So, First Brands goes bankrupt. Okay, so we'll write First Brands right here. They go bankrupt. Now, who loses money? Well, who loses money is all of the people who invested in the slices of crap over here. All these people are now sad. They lost a lot of money. But guess who made a lot of money? Well, remember how First Brands was audited by BDO that got fined $2 million for sucking at accounts receivable auditing? And here they are auditing First Brands for accounts receivable. Well, their lender is a company called Apollo. Apollo Asset Management has lent BDO $1.3 billion. So Apollo has a loan to BDO, the auditor, for $1.3 billion. And First Brand is experiencing financial difficulties. And so what does First Brands do? First Brand says, hey, we need to raise some money. Guess who gets a first look? Apollo. Apollo comes in and says, hey, so you guys need some money? Show us the stuff. Apollo, in 2024, gets a first look to provide credit. So basically to provide a loan, to provide a bailout. And they don't. Instead, they short it. They short First Brands with a credit default swap is what they used here, which is the same crap that we saw in 2007 and 2008. Apollo goes in, buys credit default swaps on First Brands because they're like, that is a flaming pile of poop. And so they set up their short position because they got the first look because they happened to lend a lot of money to the very auditor who got fined for failing on the same stuff that they should have been watching First Brands on. Apollo didn't rely on BDO because they, I feel like, realized that was just a layer of bullshit. Apollo actually looked at the stuff and they're like, this is bad. This is a flaming pile of doo-doo. Let's short it. And that got no attention for, the last year. And people are like, all right, whatever. You took out those credit default swaps. Big deal. That's okay. It was just a matter of time. And sure enough, now Apollo, they look like geniuses. Or they had insider information. And this is how the suits always win. And so what happened over the last 24 hours wasn't really about this company with $11.6 billion of liabilities. Who cares? Like, in the grand scheme of things, is an amount of $11.6 billion really that big of a deal? No. You know, you've got these emails circulating on Twitter where people are like, you know, you've got this email going in, hey, you know, can you guys tell us, did First Brands actually get $1.9 billion? What happened to it? How much money do you guys have in the segregated account for those receivables? We don't know, and zero. In other words, like, over $2 billion of money vanished at First Brands. People don't know what the hell happened. Like, it's just gone. What they were doing is they were double, triple dipping. And then they were blowing the money to finance probably, I mean, we don't know for sure, but it'll all come out over time. But to finance, you know, the CEO's lifestyle or whatever with his Ohio mansion or some crap. I hate this stuff. And then they got crappy audits to boot. So what ends up happening is First Brands goes under and you get losses that circulate. You get JP Morgan down $170 million. You've got Raystone down $2.3 billion. You've got Jefferies down up to $715 million. You've got UBS with a $500 million exposure. You've got Katsumi Global. This is a Japanese company that's wholly owned by Nuchu and Mitsu. Probably screwing up those names. They extended $1.75 billion to First Brands. And you might wonder, like, why are these companies extending debt to First Brands? It's because the yields were good, man. The yields were good. The product paid a good commission, probably. You know, we're assuming that because that's what the bankers do. This is one of the reasons why I've gotten such a hate on for JP Morgan. Because like when I was starting my career, I'm like, oh my gosh, JP Morgan, the biggest bank in the world, this is great. They're going to give you all these great products or whatever. But you know what it turned into? It literally turned into the schmucks at JP Morgan going, hey, Kevin, you should sell your Tesla stock and invest in our JP Morgan product. And I'm like, you schmucks, you call me all the damn time to try to pressure me to sell Tesla stock to invest in your JP Morgan products so you guys can make your damn fees. That's all it is. That's all banking is. It's so annoying. And you know, now I look at like, sorry, a little tangential here, but I look at like Mercury Bank. I'm sorry, like I don't even have an official referral relationship with them, but I did take the affiliate link that they give, banking done right, Merc. But it's only because it's not that I want to pitch that. I really don't care. It's that I use like Mercury now and I'm like, wow, the technology they have is so much better than the crap at JP Morgan. I'm so excited about it. And I combine that with like the productized business that is banking and I hate it. I hate banks. You don't hate the big banks enough. But understand, so much of this is just layered upon layered fugazi. And that's the scary part, is the layered on layered fugazi. Is that the bankers are like, hey, this is good. Why is it good? Well, because Jefferies says it's good. Okay, well, why does Jefferies think it's good? Well, Jefferies thinks it's good because, you know, they're audited by BDO. Do we believe BDO? Well, it's an auditor. Why wouldn't you? Maybe because they got sanctioned for accounts receivable nonsense on a company that went bankrupt. And now here's another one that we're supposed to believe them on. And Apollo's shorting them because they happen to have the insider info? That don't sound too good. But anyway, so what you end up with is just First Brands going under. Now, how does this apply to the rest of the economy? Well, it tells you that now it's not a First Brands issue. What it tells you is you are in a shock-prone environment. And what do you think bankers and lenders do now? Bankers and lenders now go, oh man, the cat's out of the bag. There are some crappy audits going on and there are some crappy balance sheets. So what are we gonna do? We're gonna go grab the sheets and we're gonna go, you, look into the balance sheet for this company we're lending to. You, look at the balance sheet for this company we're lending to. You, look into the balance sheet. And so all of a sudden you get executives. Like, you think JP Morgan wants to be on TV talking about how they lost money lending to a cockroach? That's embarrassing for these people. So now all of the suits are gonna go, bro, check this shit, because this is bad. And when that happens across the board, lending starts tightening. And that's what you have to be careful of. It's not First Brands. Nobody cares. It's not Zion's Bank and these two guys that are supposedly frauds. It's not Western Alliance with the same two guys that are supposedly frauds. It's the same crap that happened in 2008. That's what the problem here is. In a low liquidity environment where all of a sudden the repo facility is starting to pop off. Hopefully it doesn't keep popping off. But I mean, look, Reuters is reporting on this. U.S. banks borrowed $6.5 billion from the Federal Reserve standing repo facility on Wednesday, central bank data showed. The repurchase rate suggests tightness in meeting funding obligations with large net treasury settlement due this week. The rise in the repo was unusual. This is more of a sign that liquidity is slowly but surely decreasing. It's not alarming yet, but it's a trap. You know, and mind you, this is why Powell is turning dovish on the vacuum cleaner. You know, Powell, just last week, he told us that some signs have begun to emerge that liquidity conditions are gradually tightening. That's bad. When people start running out of money, at the same time as they start doubting the financials and they start thinking everything's a fraud, then they get fearful. They run into gold and they get out of any kind of complicated financial instrument. This is one of the reasons why I believe Bitcoin is having a little bit of a struggle here recently. Now, it's not that Bitcoin is inherently complicated. Bitcoin's having, in my opinion, just basic technicals here, the worst sell-off that we've seen since the liberation, like the most rapid sell-off that we've seen since liberation and the Japanese carry trade, days of last August. Okay, we're having the worst sell-off since then. Now, does that mean it's going to sustain? TBD, we'll talk about that. But what it is less money is flowing into the strategies of people like Michael Saylor, with all these leveraged ETFs and monetize the stock to try to buy more Bitcoin. And people are looking for a bailout from Michael Saylor. And it'll work until it doesn't. See, that's the thing. Yesterday, Bitcoin went down to 106,000 and people on social media were losing their SH9T going, holy crap, Michael Saylor, please buy. Because they realized Daddy is the only thing propping up the Bitcoin valuation right now. Institutions have come in. Retail's come in. We need more leverage buying from Michael Saylor in this environment. That's very bad short term because MicroStrategy is on an ugly downtrend. Look at this. Since July, you're down from $456 down to $284. That is a decline of 38% on MicroStrategy stock. Now, MicroStrategy stock, you have to think of it like a ballast. Okay, so it's sort of like it's a buffer. When MicroStrategy goes to zero, which eventually they will have printed so many shares, they will have diluted their shareholders to zero. When MicroStrategy's premium goes away and they keep diluting their shareholders, that buying support for Bitcoin gets rugged. That's your biggest risk for Bitcoin, but it's also the most bullish thing for Bitcoin. I tell people I want to load up on Bitcoin when Michael Saylor goes bankrupt because it means Daddy got flushed out. And when leveraged Daddy gets flushed out, that's the best time to buy. When the leveraged people, when the emperor wears no clothes, and all of a sudden you're like, wow, look at all the debt get flushed out, that's the time to buy. Anyway, it's a little rant on Bitcoin. But the point is, it's related because this whole financial system right now is built up on a pile of debt. And if people start doubting debt and credit spreads start skyrocketing and credit and lending standards collapse, or like tightness increases, right? The availability of credit collapses, you have no more legs to stand on. Realize First Brands was paying like 9%. Actually, no, I'm sorry. BDO, the auditor who is auditing First Brands, you know how much money they pay in interest? 9%. BDO, Apollo, Loan, cut staff. They're cutting staff. The very auditor. Look at this. You can't make this stuff up. This shows you how bad debt is, okay? BDO, US, lays off employees amid Apollo's debt repayment. Apollo is the principal financier to BDO, providing a loan facility worth $1.3 billion to fund their employee stock ownership plan. And as a result, now BDO has laid off employees to reduce expenses and is considering new debt arrangements. So in other words, they're laying off staff because they're so out of money. They can't pay for this. They're paying 9% interest on these loans, which is insane. Mind you, Elon Musk via XAI is paying 12.5% interest for his NVIDIA lease credit line. He can't even buy the NVIDIA chips because he's out of money. So he's having to lease the NVIDIA chips via a lease option with 12.5% interest rates at 40% down. He's putting 40% down while Meta's putting 10% down because lenders are starting to get smarter. They're starting to go, we got to be a little bit more careful here. There it is. BDO debt is currently paying interest of 9%. These are insane interest rates. These are very, very high. And that's an auditor. An auditor is paying 9%. And this comes at the same time as Options activity has never been higher. 1 week ago Friday, we had the highest level of options activities traded ever in the history of options, October 17th. That follows Liberation Day, which was also a pretty remarkable day for options trading. But look at this. Options are a form of leverage, absolutely skyrocketing. Margin debt is a form of leverage. All-time highs on margin debt. Leveraged ETFs aren't even considered in all of this. This entire economy is propped up on debt. Now, is it going to collapse? Well, not necessarily. There are things that can happen, and The Economist actually had a great piece on, what we could do to sort of avoid this. And so here is the recipe to avoid profit taking. Number one, the private credit disaster blows over with no more large bankruptcies or very limited bankruptcies, and people end up saying, see, it was idiosyncratic after all. There's no problem here, no new banking crisis, everything's fine. Best case scenario number one, condition number one. There are 3 conditions, okay? 3 conditions for the boom to keep going. Number one, private credit blows over. Number 2, tariffs don't actually end up hurting the economy, not in the last 6 months, but the next 6 months. That's where it matters more because, people pulled forward inventory and built up inventory to insulate from tariffs. That insulation wears thin. When the insulation wears thin, that's when we're going to actually see the real pain of tariffs. And then you will know if the economy actually receives any kind of damage. Okay. Number 3, the AI bubble doesn't pop. As long as we don't have a private credit disaster, tariffs that hurt, or an AI bubble that pops, as long as we don't get any of those 3, we can keep going, okay? We're going to soft land. We'll go back to all-time highs. Calls on the Q700, baby. We's going to the moon. If any of those go poopy-doopy, we're screwed because we're sitting on a mountain of toxic debt. We can't even trust the damn auditors anymore. That's scary. So, what's my point of view on this? Like, what am I doing? Well, you already know this. To some extent, if you've been paying attention, very clear on this. There are short-term trades that you can make. We talk about those in our alpha report every morning. People made great money this morning on the plays that we talked about this morning. Mind you, I was also bearish on CoreWeave and MP Materials. MP Material is now down over 20% since my call of a top. When it was like in the 80s, I'm like, this is going to go to 100, and it's going down. It literally went to 100. In pre-market, technically, it went to 104. And it's been down 20% since then. Down like 25% if you consider the 104 or 24%. But anyway, so join the alpha report. But beyond that, the other thing that you want to watch, credit spreads. We are at complacency levels of credit spreads. This is insane. Credit spreads are so low right now. There's only really one way credit spreads are going to go, and it's up. That means credit is going to get harder and less available. Now, we've had other cases where credit has become less available, but you have to think about what's added onto the crap here. Stocks at all-time highs, the actual effects of tariffs, and jobs. Those are 3 things that make this potential credit event even worse. Like, we didn't have stocks at all-time highs in 23 during the banking crisis. We already had a stock sell-off over here during this credit event. We didn't have high debt during these scenarios. We weren't at the highest levels of margin or options trading ever in any of these other scenarios. That's all unique to now. And we didn't have a jobs issue. Here, we started having a jobs issue here around the Japanese carry trade. Started to. Those were the early warning signs. I think the enthusiasm of Trump winning really put pause on this for a while, which was great. But the bills got to get paid. So there are definitely, people ask me, they're like, all right, Kevin, I go to, meetkevin.com/data to see your bear bull scale. I should really update it because I feel a little more bearish today. But, whatever. I think it's at 4.2. Maybe it's like what? It's 4.3s, whatever. Maybe I update it to like 3.9 or 4.0, right? I'll do that after this. Big deal. The point is, there's a reason why I haven't been over a 5. There's a reason why I don't want debt. Like I said, you know what I'm doing. When does Kevin pay off debt? I just paid off my house. And the house I bought for my dad. Paid off, okay? I have no car debt. I'm also looking at, there's no debt in my stock portfolio, right? So I look at this and I go, I I'm not playing the debt game in this environment because I am nervous about where the economy sits. And so I think of that as just sort of like hopefully a warning for everybody, because I think in the near term, there's going to be a lot of profit taking in this market. Now, it could just be seasonal October, and like I said, maybe the credit stress will go away, and we won't see credit yields widen, we won't see bad jobs numbers, and we won't see an AI issue. But there's so much fugazi that making like wild bets on margin right now or leverage that everything is going to be fine, I don't think it's worth going to zero. You know what I mean? Like, take some money off the Vegas table, be safe, and if somebody else makes a little bit more money, who cares? Stay away from that toxicity of relativity, right? Somebody says Dave Ramsey would be proud of you, yeah. Somebody else says buy gold. Gold is actually your warning sign, right? I mean, I'm not going to buy gold right now because, you know, usually what happens is you get these crazy run-ups of gold, and we've talked about this before, and then obviously when poop actually hits the fan, gold also comes down. But gold is, to me, more of a warning sign than an investment vehicle. It's a tool that tells you, hey, people are concerned. Where do people go when they take profits on stocks? Think about this for a moment. When people take profits on stocks, usually they're looking for the next trend. They're not trying to sit in a money market. That's boring. So what's the next trend? Gold or bonds? Bonds actually have a good shot. A little bit of a give back today, but bonds are like the stepchild of gold right now. Look at the slow uptrend you're getting on the 25-year average maturity bond right here. This is TLT. It actually says 20-year treasury bond, but it actually says 20-plus year because the average maturity is like 25 years. But you've had an uptrend on TLT, for example, since May. And you're potentially breaking out of the 90 level over here. You know, it's down 20 bips today. But if we actually get to the next gulf over here, I don't know when it'll happen, but as these shocks become more pronounced, there's a good shot of TLT rapidly going over 100. It's because it'll be a bond play. You know, people will flee to the bond play. It's funny, this morning in the Alpha report, I said, hey, we're, 137, this isn't looking good. Like, we're back at 137 again. It just cannot stay above 137. That's why I was bearish on CoreWeave this morning. But anyway, those are my thoughts on what the hell just happened over the last 24 hours. It's a pretty big deal.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.